Let's talk about taxes. I know that not the most exciting topic, but trust me, this is important stuff, especially when it comes to your investments. Today we're diving into the world of capital gains tax. Don't worry, I'm here to break it down in a way that's easy to understand. So, what exactly is capital gains tax? Simply put, it's a tax you pay on the profit you make when you sell an asset for more than you paid for it. This could be anything from stocks and bonds to real estate. Think of it like this. You buy a painting for $500 and sell it a few years later for $1,000. That $500 profit, that's a capital gain, my friend. And yes, the government wants a piece of that pie. Why should you care? Because capital gains tax can eat into your profits if you're not careful. But the good news is there are ways to minimize your tax liability and keep more of your hard-earned money. Stay tuned. Now let's delve a bit deeper. Capital gains are classified into two types, short-term and long-term. Short-term capital gains are profits from assets held for 1 year or less. These are typically taxed at your ordinary income tax rate. On the other hand, long-term capital gains are from assets held for more than a year. These usually benefit from lower tax rates. Understanding the difference between these two can significantly impact your investment strategy. For instance, holding onto an asset for just a bit longer could mean paying less in taxes. Timing your sales can be a strategic move to maximize your after-tax returns. Another key point to consider is the concept of tax loss harvesting. This involves selling investments at a loss to offset the gains you've made, thereby reducing your overall tax liability. It's a smart way to manage your portfolio and keep more money in your pocket. Diversifying your investments can also help manage your capital gains tax. By spreading your investments across various asset classes, you can better control when and how you realize gains. Remember, the goal is to make your money work for you, not the other way around. So stay informed, plan wisely, and you'll be well on your way to maximizing your investment returns while minimizing your tax burden. Stay tuned for more tips and strategies. Now, not all capital gains are created equal. Understanding the difference between short-term and long-term capital gains is crucial for any investor. There are two main types, short-term and long-term. Each has its own set of rules and tax implications that can significantly impact your net returns. The difference lies in how long you hold onto the asset before selling it. This holding period determines whether your gain is classified as short-term or long-term. Short-term capital gains apply to assets you've held for 1 year or less. This is often the case for day traders or those looking to make quick profits. Think of it as a quick flip. You buy an asset, hold it for a short period, and then sell it to capitalize on immediate market movements. The downside, they're taxed at your ordinary income tax rate, which can be higher than you'd like. This means you could end up paying a significant portion of your gains in taxes. Long-term capital gains, on the other hand, are the real sweet spot. These gains apply to assets you've held for more than a year. Holding on to an asset for over a year can be beneficial in more ways than one. Not only does it allow your investment to grow, but it also offers tax advantages. The beauty of long-term gains is that they're taxed at a lower rate than your ordinary income. This lower tax rate can make a substantial difference in your overall returns. That means more money in your pocket. By holding onto your investments for a longer period, you can maximize your gains and minimize your tax liability. The takeaway? Holding onto your investments for the long haul can really pay off when it comes to taxes. Patience, my friend, patience. In the world of investing, sometimes the best strategy is to sit back, relax, and let time do its magic. So, whether you're a seasoned investor or just starting out, understanding the nuances of short-term and long-term capital gains can help you make more informed decisions. Remember, the key to successful investing often lies in the details. By being aware of these differences, you can better plan your investment strategy and work towards achieving your financial goals. Happy investing! Okay, so how do you actually calculate how much capital gains tax you owe? It's actually simpler than you might think. It all starts with determining your cost basis. Your cost basis is essentially what you originally paid for the asset. Let's say you bought a share of stock for $50. That $50 is your cost basis. Now, fast forward a year and you decide to sell that share for $75. Congratulations, you have a $25 capital gain. $75 selling price minus $50 cost basis equals $25 capital gain. To figure out your tax liability, you'll need to know the capital gains tax rates for your income level. Don't worry, we'll cover that in the next section. Here's the good news. The capital gains tax rates are typically lower than ordinary income tax rates, but they do vary depending on your income level and filing status. For 2024 to 2025, if you're in the lowest tax bracket, you might pay 0% on your long-term capital gains. That's right, zero. For those in higher tax brackets, the rates go up to 15% or 20%. Short-term capital gains, as we discussed earlier, are taxed as ordinary income. These rates can range from 10% to 37%, depending on your income. The takeaway: knowing your tax bracket is key to understanding how much capital gains tax you'll actually owe. Section 5. Minimizing your tax burden. Strategies for smart investors. Now let's talk strategy. The good news is there are several smart moves you can make to minimize your capital gains tax and keep more of your money working for you. First and foremost, hold on to your investments for the long term. Remember, those long-term capital gains tax rates are much more favorable than short-term rates. Another strategy is to take advantage of tax-advantaged accounts like 401, KSEs and IRAs. With these accounts, you can defer or even avoid paying capital gains tax altogether. Section 6. Understanding the impact of capital gains on investment returns. It's crucial to understand that capital gains tax can have a significant impact on your overall investment returns. Let's say you invest $10,000 and earn a 10% return, giving you a $1,000 profit. Sounds great, right? But hold on, if you have to pay, say, 15% in capital gains tax on that $1,000 profit, you're left with $850 after taxes. That's still a profit, but it's important to factor in the tax implications when setting investment goals and making decisions. Section 7. Example scenarios, putting it all together. Let's look at a couple of scenarios to illustrate how this works in real life. These examples will help you understand the practical application of the concepts we've discussed so far. Scenario 1. Sarah, an avid investor, decides to buy 100 shares of company XYZ stock. She purchases these shares at $50 per share, making her total investment $5,000. Sarah has done her research and believes in the company's potential for growth. A year later, her prediction comes true. The stock price rises to $60 per share. Sarah decides it's the right time to sell all 100 shares. She sells them for a total of $6,000, making a tidy profit. Her capital gain from this transaction is $1,000, calculated by subtracting her initial investment of $5,000 from the $6,000 she received from the sale. Since Sarah held the stock for more than a year, she qualifies for the long-term capital gains tax rate, which is generally lower than the short-term rate. This means she will pay less in taxes on her $1,000 profit, allowing her to keep more of her earnings. Scenario 2. John, on the other hand, is interested in real estate. He buys a rental property for $200,000. Over the next 5 years, he manages the property well, ensuring it remains in good condition and attracts reliable tenants. After 5 years, the property's value appreciates, and John decides to sell it for $300,000. His capital gain from this sale is $100,000, which is the difference between the selling price and his original purchase price. John will need to pay capital gains tax on his $100,000 profit. However, there are strategies available to him to potentially reduce his tax liability. One such strategy is the 1031 exchange, which allows him to defer paying taxes by reinvesting the proceeds from the sale into a similar property. This can be a powerful tool for real estate investors looking to grow their portfolios while managing their tax obligations. These scenarios highlight the importance of understanding capital gains and the tax implications of your investments. Whether you're investing in stocks or real estate, being aware of these concepts can help you make more informed decisions and optimize your financial outcomes. Remember, the key to successful investing is not just about making profits, but also about managing your tax liabilities effectively. By doing so, you can maximize your returns and achieve your financial goals more efficiently. In conclusion, always consider the long-term impact of your investment decisions. Seek advice from financial professionals when needed, and stay informed about the latest tax laws and investment strategies. This knowledge will empower you to make better choices and secure a prosperous financial future. With careful planning and smart investment strategies, you can put it all together and build a solid foundation for your financial well-being. Thank you for joining us in this journey of financial education. We hope these examples have provided you with valuable insights and practical knowledge. Section 8. The importance of staying informed. The world of taxes is constantly changing. New laws are passed, rates are adjusted, and what was true yesterday might not be true tomorrow. That's why it's so important to stay informed and up to date on the latest capital gains tax rules. Don't be afraid to seek guidance from a qualified financial advisor or tax professional. They can help you navigate the complexities of the tax code and make smart investment decisions that align with your financial goals. Section 9. Conclusion. Navigating the world of capital gains. Understanding capital gains tax might seem daunting at first, but it's an essential part of being a savvy investor. By grasping the basics like the difference between short-term and long-term gains and the strategies for reducing your tax liability, you can make informed decisions that benefit your bottom line. Remember, knowledge is power, especially when it comes to your money.